The Nasdaq coming off its worst day in more than 2 weeks. Our next guest is in charge of corporate credit at Goldman Sachs, advising America's biggest companies on their multi-billion-dollar financings. Jonny Fine is back, Goldman Sachs Global Head of Investment Grade Debt. Welcome. Good to have you.
Good morning. Thanks for having me back.
Just first as a check on the credit market, because we sometimes look there, we often look there to see if there's a recession coming or economic pain or stress. As a result of all this tariffs, what do you see?
A lot of resilience. So it's probably the word I've used most frequently when describing investment-grade credit markets, at least from a primary market perspective, over the course of the year. So notwithstanding spikes in vol, notwithstanding significant drawdowns in equities, credit markets roll on. In fact, some of the largest deals of the year, the Mars acquisition financing was a $26 billion deal. The Synopsys acquisition financing was a $10 billion deal. That came in a week where stocks sold off 3% and the VIX spiked up to 26.5%. So the reality is that our market continues to move on unfazed. And there's maybe some signs that might change in kind of the near to medium term. But for now, resilience has been kind of the primary word I've been using. So
markets open, companies are borrowing.
Yep.
That's all good. What about what we're seeing in treasuries? Now we're seeing rates higher on the back of tariffs. Is it ultimately going to mean higher rates or lower rates?
So it's kind of interesting. I think treasuries have found, especially in the 10-year part of the curve, a very stable range, notwithstanding the noise that's out there. I looked at a couple different things. If you look at the MOVE index, which measures implied vol in the treasury market in the same way that the VIX does for the equity market, the MOVE index is at its lowest quintile in the last 12 months. And if you look at 10-year notes over the course of this month, their high-low range over the course of this month has been the lowest that we've seen in about 5 years. So I'd actually say that rates further out the curve, certainly in 10s, have been very, very well anchored in recent weeks, even notwithstanding this tariff noise.
But do you think we'll see 4% first or, I don't know, something closer to 5%?
4% I think we'll see first, although I think the reality is that why treasuries are stable at the level that they're at right now is that the noise we had at the beginning of the year when we thought that this administration would be fiscally profligate, which was conventional wisdom going into the election, that's obviously been turned on its head. Obviously, Scott Bessent has been very aggressive about talking about deficit reduction. Where I think the market is at right now is that they no longer believe that this administration will blow out the deficit. And that creates, call it a 4.25%, 4 3/8 10-year yield as being fair value. Where I think we need to see movement from here is when we get a budget, which is probably going to be at earliest May, i.e. deficit reduction is really a show-me story. I don't think the market is buying anything other than maybe there being no change in the current deficit. Until they see that evolve from any announcements in May, I think we'll stay anchored in and around these ranges. But my bet is that we see 4 before we see 4 3/4 again.
Does the market, do you think, want to see the extension of tax cuts, or is that a vulnerability on the deficit front?
No, I think the market wants to see the extension. They obviously want it to see it to be paid for, so there's no, obviously, increase in deficits from here. And we'll see if we can take Treasury Secretary Bessent at his word. Been very aggressive talking about deficit reduction. Obviously, his recent podcast got a lot of attention in that regard. I wouldn't necessarily bet against him, but obviously it's a show-me story, and how that evolves in the coming months, I think, will be very deterministic of whether or not we get down to 4, or even I think we could get down to 3 3/4%.